Hi, this is Jim Welsh from macotides.com. Thanks for tuning in. Contrary opinion is one of the most powerful investment tools, but is also one of the most difficult to master since it requires going against the crowd. As humans, we like running in packs and with the crowd. And contrary opinion requires us to remove ourselves from the crowd and, in a sense, differ from the popular opinion. So, how does one identify when contrary opinion position is warranted? I look at a lot of sentiment measures and positioning and some other tools. So let's take a look how various measures of sentiment are showing right now. IPO activity has increased significantly this year, but the most important point is that 81% of the deals that have come public have not had any earnings prior to going public in the prior year. That's the same percentage as in 2000. So what does this mean? This means investors are willing to bet on companies that truly are unproven, don't have earnings, and yet they believe the stocks are going to go up. And this year they've been rewarded. They have in fact gone up. But this heightened activity in IPOs and playing in this area is usually reflection of speculation and typically happens after the stock market has been going up not weeks or months, but years. So this is a warning sign that speculation is on a higher level. Hedge fund exposure. They're known as or thought of as the masters of the universe, when in reality they're nothing more than trend followers. And if you track their exposure over the last 12 months, you can see what I mean. Last summer, as the market was grinding higher, they cut their exposure and went into a net short position. As the market kept plodding up in August and September, they reversed quickly and ramped up their exposure significantly just in time for the sell-off in the fourth quarter. As the market began to rebound in early 2019, they didn't believe it, but in April, they did start to believe it, ramped up their exposure just in time for the sell-off in May. As the market rebounded in June and early July, they've significantly ramped up their exposure. That money is already in the market, and based on their track record, it's an indication that we're probably nearing a high. Risk parity funds are much the same way. You can see how they fluctuated. Last year, as the market sold off in the fourth quarter, they cut back their exposure. But that was right after they had increased their exposure very significantly at the end of 2017 and early 2018. So they are really also trend followers. Investors Intelligence numbers the percentage of investment writers who are bullish or bears, and then I net that number out. This past week was 41%. As you can see, that's a real high percentage. The last 3 times that's happened, the market was nearing an important high. Traders are also bullish. The call-put ratio is above the red line, as you can see, and this is the 10-day moving average. And over the last year or so, year and a half, each time the call-put ratio has gotten to this level, the market has either made a short-term pullback, as it did in June of last year, with about a 3% decline, 3.5%. This last May was about 7.5%, but of course it also presaged the sharp declines last in the fourth quarter and the first quarter of 2018. So, with all these measures of sentiment, flashing, if you will, a caution sign, I'll go back to the bearish megaphone pattern that has appeared in the S&P 500. What it implies is that we're nearing the end of the rebound that began in December of last year. And based on the megaphone pattern, the market is vulnerable to a decline that takes the S&P down to the lows of last December. Now that's going to take some significant negative fundamental news. So short of that, I think the S&P at a minimum, given these warning signs being flashed by sentiment, could pull back to 2,800 or key support near 2,750. So I believe the market is vulnerable to a sharp shakeout over the next 1 to 2 months. Thanks for tuning in. May something good happen to you today.